Hi everyone, and welcome to Finance at JCL. Great to have you with me. We're on special channel birthday challenge. So channel's been going for a year, so I've got a challenge of delivering 14 videos for you across 14 days. So this is day 3 of the challenge. If you want to have a look at the first 2, I'll leave links to those down below. So we're going to look at how to value a stock part 2 today. Part 1, which was looking at the book value. So there's a link for that coming up. But this is going to be around discounted cash flow. So if you'd like to learn about discounted cash flow and how to perform evaluation by this method, you're in the right place. So I've got a template here, which is available to those on the Patreon site. And we're going to use this as the basis for explaining the discounted cash flow example. The first thing is actually, what is discounted cash flow? That's the starting point. So if you're new to this, we'll go through it. Now, what we need to look at with discounted cash flow is, imagine you owned the entirety of the company, or you were going to buy the whole company. The benefit to you as an owner would effectively be the free cash flow that the business generates. Because with that free cash flow, what you can then do is either reinvest in the company, you can pay a dividend, or you can buy back shares. Those are the 3 main methods that you can return value to shareholders. So if you owned the entire company, you get the full benefit of that. So another term for free cash flow is owner's earnings. That's what Warren Buffett has been known to call it. So we've established that free cash flow is effectively your benefit as owner of the company. So therefore, what scenarios would free cash flow be useful to use to assess a company? Have a look here at Morningstar, which has a very helpful 10 years of history. The discounted cash flow methods cannot be used where the free cash flow of a company is negative, because the mathematics doesn't work in those scenarios. And if you've got negative owner's earnings, then you can't really assess the benefits to you. It also doesn't really work for banks, financial companies, because their earnings aren't really based on the flow of money. And it isn't quite as good for companies that are very volatile in their earnings. So we perhaps look at someone like Shell, an oil company, where their cash flow actually fluctuates wildly year to year, potentially, depending on the price of oil. Those situations, it's not so good, for example. But in the situation where it's good is someone like Intel here, which is our example company, where you kind of have steady cash flow that over time starts inching up as the company grows. Those more predictable companies, this is a much more effective valuation method. You'll get better results from it. So we've discussed free cash flow, or how it represents the owner's earnings and your value as a shareholder, when to use it, but also how to actually find it is the next point. I've got here the Intel example on morningstar.com. And you'll notice a line going across here, which is operating cash flow. Now, this appears in company accounts in the cash flow statement. But what doesn't appear is the actual free cash flow metric that I've been referencing. And you actually have to calculate that manually in accounts by removing the capital expenditure of the companies. Now, the reason I like Morningstar is, first of all, it gives you a 10-year history, but secondly, it actually calculates this free cash flow figure for you. So it saves you a bit of work in having to calculate it yourself. So we look at this Intel example, you can see that in the most recent 12 months, they had an operating cash flow of very large, $35 billion. They've reinvested 16 of that to capital expenditure. And then their benefit to owners, free cash flow, owners' earnings, 19 billion. And that's the number that we'll use. So that's how you find it. So hopefully that was a useful introduction. We'll now look at assuming all those boxes are ticked as it were, and you've decided, yeah, this is the right time, the right thing to do. I'm now trying to value a company. I've checked it's due to an investment, it's not likely to fail, etc. I want to work out the underlying value of the company, or what we would call the intrinsic value, and that's what we'll go through now. So with this example on my on the simple templates I've got here, you can have much more complex templates. This one I'm trying to keep it nice and straightforward. So the first thing here is the actual exchange rate. Now here it's 1-to-1 because Intel's results here you can see here in US dollars, and their stock market quotation you can see here is also in US dollars, so therefore there's no currency adjustments required. The general rule of thumb on a discounted cash flow, is a 10-year simulation, but you may choose to use different durations of simulation, perhaps if you know you're going to sell a company earlier. And then the very important measure here is the discount rate. So I talked about free cash flow that you can find, but the actual method is called discounted cash flow. And the reason for that is we're using this discount rate here. For me, I've used 10% in this example. We want to discount future cash flows of the business to today's value because we're buying the company in today's money. So I'm saying 10% is a number, and that's because I want to get a minimum of a 10% per year return on my investment. You can use whatever number you like, but it should be the return on investment that you want to make. So it could be 15%. Look at something like 5%, you might be better off using an index. So with this 10% example, what that means is the cash flow in year zero, i.e. today, is not discounted. So in Intel's case, I've got 19 billion here, and the discount factor or discount rate is 1, so there's no adjustment. So in today's money, the 19 billion for this year is 19 billion, which logically makes sense. Now, if the cash flow grows at 6% in the first year, after that first year, sort of the raw number is 20.35 billion, you can see. But that gets discounted at 10%. So you divide that by the discount factor of 1.1 and you get 18.5 billion. And then that kind of discount factor is bigger because for the second year it's 10% is 10%, and so on and so on and so on. So the discount factor grows as you get further in the future, reflect the fact that the money in the future is worth less by that factor of 10% a year than the money today, because you're assuming that you can get 10% on your money you didn't invest in this company. So that's the discounting point. You also need, as I mentioned there, to work out the growth rate. So how much is the cash flow going to grow in each year? So my calculator will allow you to put a bespoke rate in for each year. And the way you could find that is through your own research. You could have a look here at Yahoo and look at the analyst view, which says here 5.43% a year for the next 5 years of earnings growth. You could look at their earnings growth for the last 10 years or the last 5 years. See here it's 19%, and you could extrapolate that forward because what's the best view? Well, the evidence they've produced for the last 5 years. So there's plenty of ways that you could create that number, but it's a very important number. So you have to have some kind of consistency and logic around why you've used the growth rates that you use. If you're pinging out numbers like 50% a year, that's probably a bit unrealistic, and the company could get incredibly large over 10 years if you've got 50% a year. So you need to use a realistic figure. And if you're unsure, always use a lower number to be more conservative, because rule one of investing could be argued to be don't lose money. So be conservative in your calculation. So we've talked about that, and now what we also need to enter in here, what's called the terminal multiple. So this kind of calculation section will work out the amount of cash a company produces each year, discounts it back to today's value by the discount rate. But actually, you're going to sell, let's say, the company after 10 years. What PE ratio is that company going to be trading at in the future? And therefore, you would multiply the amount of cash or earnings it has. So let's say in year 10, I've got here terminal multiple 15. So that's effectively saying a PE ratio of 15. So I take the cash flow in year 10, multiply it by 15 to get the sale price for the company. And I've also got here the today's PE ratio, which is 13 in the market, just as a comparison, so you can see whether that future PE is that you've put in is unrealistic. And that terminal multiple does have a big impact to the calculation. So again, you've got to be quite careful not to use an excessive number. 15, I think, for Intel's a good one because it's a little bit higher than what they're at today. And 15 is kind of the US market overall average over a long period of time. And what we have also input here is the number of shares. Number of shares is important because I've assumed in all these calculations we own the whole company. I've added up all the cash it will create discounted to today's price, and the terminal multiple as well when you sell. Then you need to divide that by the number of shares to work out what is the value of the company, the underlying value, the intrinsic value per share. So that's an important figure. You can find that on Yahoo Finance on the statistics page. There it is. And finally, here I have the share price today. So the share price is important because I just mentioned we're going to calculate that underlying intrinsic value per share, which will then be compared to the market share price. And you've got three scenarios. If the market price is higher than the underlying value per share, the implication is that it is overpriced and you will therefore get less than a 10% return with no margin of safety if you buy the stock. And if you want 10% a year, and that's the case, you probably shouldn't buy it. You've got the opposite situation where the market price is lower than your underlying value per share. And therefore, you could say there's a margin of safety. So let's say the price here is $57. Let's say the calculated intrinsic value was 100. You then got that margin of safety up to 100, where the company is a little bit undervalued. The control is if the share price in the market is 57 and the intrinsic value is 57, the two numbers are equal. That specifically means that you are expecting to get a 10% a year return. So that intrinsic value is if the price is this, you get 10% or whatever your discount rate is. I'm hoping that's clear. Drop me some comments below if you found that useful, particularly if you're new to discounted cash flow. So calculations wise, just updated this. So we talked about the inputs, we've talked about the calculations, and we'll now look at the valuation. But what I didn't mention, of course, is the starting free cash flow, which is here as 19 billion. Now, what I've done is I've used the 19 billion, which is their latest number, but there are other options. Let's say this number was unusually high or unusually low because of an abnormal year. You may choose not to use that number, but to use a different year's number. You might choose to take an average of several years worth of free cash flow to get a representative conservative view. If the company is growing over time, you are going to kind of lower your starting point, perhaps unnecessarily so. I'm happy that 19 billion is a good number to use for Intel for free cash flow, so I've used that. And yeah, I've had a fiddle around with a couple of the growth rates, and what we see is the valuation now. So valuation-wise, discounted cash flow is comprised of the total sum of the 10 years worth of discounted cash flows, plus the terminal value, which is the final year's discounted cash flow, multiplied by the PE ratio. And what that therefore equates to is, in this case, $42 a share, $47 a share, rounded. Add those two together, you get an intrinsic value of $360 billion divided by the number of shares above, 89. So if Intel was priced at $89 per share in the market, I would expect to make a 10% per year return. However, it's 57 at the moment. I've dropped that in at the top. So with 57, that means I have a 36% discount from fair value. Okay, there we have it. So I've gone through discounted cash flow, what it is, where to find it, when to use it. Got a bit of a template here. I'll upload this updated version to the Patreon group. Here are some inputs. We've gone through those. Pick your growth rates for calculations and then evaluation. And the key thing is it discounted from fair value? Other methods are available for valuing stocks, as you know, book value, price to sales, other methods as well, and I'll be going through those as part of this series. Thanks for joining me. Drop me a comment below if you found this interesting, useful, and I look forward to seeing the next one. And yeah, we're on video 4 of 14 in 14 days tomorrow. Wish me luck. Have a good day.